Something extremely unusual is happening in the silver market right now, and almost nobody in the mainstream financial world is talking about it. Behind the scenes, the global silver market is entering a phase that could completely change how gold and silver are priced in the future. Massive demand is building, inventories are tightening, and the gap between paper silver and physical silver is becoming impossible to ignore. If you follow precious metals closely, you already know that silver often moves quietly at first. But when the real move begins, it can happen very fast. And right now, many signals suggest that we may already be entering the early stages of one of the most important silver market shifts in decades. Welcome to Gold Silver Scope, where we break down the biggest developments in the gold and silver markets and explain what they could mean for investors and the global financial system. To understand what is happening today, we first need to look at one of the most important indicators in the precious metals market, the gold-to-silver ratio. This ratio simply measures how many ounces of silver it takes to buy 1 ounce of gold. Historically, this ratio has moved up and down depending on market conditions, investor sentiment, and economic stress. Not long ago, the ratio reached an extreme level of around 120 to 1. That means it took 120 ounces of silver to equal the price of 1 ounce of gold. When ratios reach such extreme levels, it often signals that one metal is significantly undervalued compared to the other. Since that moment, silver has already started to outperform gold. The ratio has now dropped dramatically to around 57 to 1. What does that mean in simple terms? It means silver has already been rising faster than gold, roughly outperforming it by about 2 times in price movement during this shift. But here is where things start to get really interesting. Even after this major move, many analysts believe the ratio could fall much further. If the ratio moves toward 25 or even 20 to 1, which has happened in past precious metals bull markets, it would mean silver could outperform gold again by another massive margin. In other words, silver could potentially double its relative performance against gold from current levels. Now the big question is, why is this happening? To answer that, we need to understand the difference between physical silver and what is called paper silver. Physical silver is the actual metal, coins, bars, and bullion stored in vaults or held by investors. Paper silver, on the other hand, exists mainly in financial markets through futures contracts and derivatives. These contracts allow traders to speculate on the price of silver without ever owning the actual metal. And this is where many experts believe the system has created a massive imbalance. Over the years, huge amounts of paper silver have been traded in futures markets. These contracts can push prices up or down quickly because they represent large amounts of metal that may not actually exist in physical form. When large groups of traders suddenly sell massive quantities of futures contracts, the price of silver can fall very quickly, even if no real physical silver is being sold. Evidence from international markets has shown that large numbers of trading accounts were recently forced to close after exceeding position limits in futures markets. This suggests that enormous speculative positions had been built up in the system, and when those positions are suddenly liquidated or forced to close, it can create violent price swings. But here is the key point that many people are missing. The price drops we sometimes see in silver are often caused by futures contracts being dumped into the market, not by real physical silver being sold. In other words, paper silver can push the price down temporarily, but it does not change the reality of physical demand. And right now, the demand for physical silver around the world is incredibly strong. Silver is no longer just a precious metal for investors. It is also a critical industrial metal used in many of the technologies that power the modern world. From electronics and medical applications to electric vehicles and solar panels, silver plays a key role in a wide range of industries. The global push toward renewable energy has made silver even more important. Solar panels alone require large amounts of silver for their electrical conductivity. As countries continue expanding solar power infrastructure, The demand for silver keeps rising. At the same time, silver is being consumed in industrial processes. Unlike gold, which is often stored and rarely used, much of the silver that gets mined is eventually used up in manufacturing. Once it is used in small electronic components or industrial products, it becomes extremely difficult and expensive to recover. This means the available supply of silver does not build up the same way gold reserves do. So on one side of the market, you have increasing global demand from technology, green energy, medicine, and industry. On the other side, you have a financial trading system dominated by paper contracts that can temporarily influence price movements. And when those two forces start to collide, the result can be explosive. Right now, the global silver market may be approaching exactly that kind of moment. Because in several major markets around the world, the price people are paying for physical silver is already significantly higher than the price shown on Western futures exchanges. That growing gap is one of the strongest signals that something unusual is developing beneath the surface of the silver market. Now let's go deeper into the part of the silver market that very few people truly understand: the global delivery system. This system is where futures contracts are supposed to be converted into actual physical silver. In theory, if someone buys a silver futures contract and decides to take delivery, the exchange must provide the real metal. That is how the system is designed to work. But the numbers we are seeing right now are raising serious questions. At the moment, the amount of open interest in the current silver delivery cycle is extremely large. Open interest simply means the number of active contracts that still exist in the market. Each of these contracts represents a promise that silver can be delivered if the buyer requests it. Right now, there are more than 200 million ounces of silver represented in open contracts, while the available deliverable supply is roughly 100 million ounces. Think about what that means. There are roughly twice as many paper claims for silver as there is physical silver available to deliver. Normally, most traders close their contracts before delivery and never request the metal. But the situation becomes dangerous if a large number of participants suddenly decide they want the actual silver instead of cash settlement. If that happens, the system could face a serious stress test. At the same time, we are seeing another major signal coming from global physical markets. In some parts of the world, buyers are already paying significantly higher prices than what is shown on Western exchanges. For example, physical silver in Asian markets has recently been trading with premiums of around $10 to $12 above the futures price. In India, another major silver market, premiums of $4 to $5 above the futures price have also been reported. When you see premiums like this, it usually means one simple thing: physical demand is extremely strong and local supply is tight. In a normal market, traders would immediately take advantage of this price difference through something called arbitrage. They would buy silver in a cheaper market and sell it in a higher-priced market, locking in a profit while bringing prices back into balance. But something unusual is happening. Many traders are hesitant to perform this arbitrage trade. The reason is simple, but very important. If a trader sells silver in a market where prices are higher, but cannot receive the physical metal from the exchange where they bought it, they would be left with a massive risk. In that situation, the trader would essentially be holding a naked short position, meaning they promised to deliver silver they never actually received. That risk is keeping many traders on the sidelines, and that hesitation itself is a signal that confidence inside the system may not be as strong as it appears on the surface. The core issue is that futures exchanges cannot simply create physical silver. They can create contracts, but they cannot print silver bars. Eventually, those contracts must be backed by real metal if delivery is requested. And that is where the upcoming delivery cycle becomes extremely important. If a large percentage of contract holders ask for delivery at the same time, The exchange would have to source enormous amounts of physical silver very quickly. That could push lease rates higher, tighten available inventory, and force prices upward. But the real danger appears if the system cannot deliver the metal that the contracts promise. If an exchange fails to deliver silver when requested, it could trigger a chain reaction across the financial system. The reason is that silver futures are part of a much larger derivative structure connected to gold markets, currency markets, and even government bond markets. In other words, silver is not just a small commodity market operating by itself. It is deeply connected to the broader financial system. A failure to deliver could damage confidence in the entire paper metals market. And once confidence breaks, it spreads quickly. Investors who once trusted paper contracts could suddenly demand physical metal instead. That shift alone could create enormous pressure on inventories because the physical silver market is actually very small compared to the scale of financial trading. Unlike gold, which central banks hold in massive reserves, there are no large global stockpiles of silver sitting in vaults. Silver is constantly being consumed by industry, technology, and manufacturing. Over time, this has quietly reduced the amount of above-ground silver available for investment. That is why many analysts believe silver could become the flashpoint of a much larger financial shift. If the delivery system becomes stressed, the impact would not stay limited to silver alone. The pressure could quickly spread into the gold market, where many of the same futures and derivative structures exist. And if confidence in those markets weakens, the effects could move even further into currencies, bonds, and the broader financial system itself. Because at the end of the day, these markets are built on trust. Trust that contracts will be honored. Trust that deliveries will be made. Trust that the financial system can perform when it is tested. But when the number of paper claims begins to exceed the available physical supply by large margins, that trust can start to crack. And when trust begins to break inside a financial system, history shows that the consequences can arrive very quickly. Right now, the global silver market may be approaching one of those moments. Because if physical demand continues rising while paper supply continues expanding, the two sides of the market will eventually collide. And when that collision happens, the price discovery process for silver could change in a way we have never seen before. To truly understand why the silver market is becoming so important right now, we have to step back and look at the bigger picture. Because what is happening in silver is not just about one metal. It is also about the global financial system and the value of the currencies we use every day. Gold and silver themselves do not really change in value the way many people think. For thousands of years, they have remained relatively stable forms of money. What actually changes is the purchasing power of the currency being used to measure them. When the price of gold or silver rises dramatically, it often means that the currency used to price them is losing value. And that is exactly what we have been witnessing in recent years. Just a few years ago, gold was trading around levels that many investors thought were already high. Since then, the price has climbed dramatically. Moves like that do not happen simply because gold suddenly becomes more useful. They happen because currencies around the world are slowly losing purchasing power. This process happens quietly at first. Governments print more money, debt levels rise, and financial systems expand through credit. For a while, everything appears stable. But over time, the supply of currency grows much faster than the supply of real assets. Eventually, markets begin to adjust. Investors start moving their wealth into things that cannot be printed. Real assets begin to attract attention again. And that is when precious metals often start to perform strongly. Silver is especially interesting in this situation because it sits at the intersection of two powerful forces. On one side, it has thousands of years of history as a form of money. On the other side, It has become an essential industrial metal used in modern technology. This combination makes silver unique. Unlike gold, which is mostly stored and rarely consumed, silver is constantly being used in electronics, solar panels, medical equipment, batteries, and many other technologies. Once silver is used in these applications, much of it becomes extremely difficult to recover. That means a large portion of the silver that has been mined throughout history is no longer easily available. At the same time, global demand for silver is increasing as technology expands and energy systems evolve. The push toward renewable energy alone requires massive quantities of silver for solar panel production. So while demand continues to grow, the available supply of investment-grade silver remains relatively small. This is one of the reasons many analysts believe the silver market could become extremely tight if investors begin shifting away from paper assets and toward physical metal. Another important factor is the structure of modern financial markets. Much of today's wealth is held through layers of intermediaries. Banks, brokers, funds, and financial institutions all sit between investors and their assets. In normal conditions, this system works smoothly. But during periods of financial stress, these layers can become points of risk. If credit markets freeze or financial institutions face pressure, access to assets can become restricted. History has shown many examples where investors suddenly realized that what they thought they owned was actually dependent on the stability of a much larger system. That is why physical assets have always played a role during times of uncertainty. Gold and silver do not depend on a bank, broker, or institution to exist. They are tangible assets that cannot default or go bankrupt. They do not rely on promises written in contracts. This is one of the reasons why many experienced investors choose to hold at least a portion of their wealth in physical precious metals. But silver has one more unique characteristic that makes the situation today even more interesting. The entire global silver market is actually very small compared to other financial markets. The amount of investment capital required to move the silver market is tiny compared to stock markets, bond markets, or currency markets. Because of that, even a relatively small shift in investor demand can have a very large impact on price. If more investors begin moving toward physical silver while industrial demand continues rising, the supply pressure could become extremely intense. And that brings us back to the situation we discussed earlier with the delivery system. If the physical market continues tightening while paper contracts continue expanding, the gap between the two could eventually force a major adjustment in how silver is priced globally. That adjustment could be sudden, and it could be powerful. For investors who are watching the precious metals market closely, the key message right now is preparation and awareness. Markets move in cycles, and the early stages of major changes often happen quietly before the wider public begins to notice. Understanding these developments early can help investors make more informed decisions about protecting their purchasing power in the long term. If you want to stay updated on the biggest developments in the gold and silver markets, make sure to follow Gold Silver Scope, where we break down complex financial events into simple insights that help you understand what is really happening behind the scenes. And if you found this analysis helpful, consider supporting the channel by liking the video and subscribing so you don't miss future updates about gold, silver, and the global financial system.